Looks like 5 minutes. Good morning and good afternoon, everybody. We're going to get started in a few minutes, so we have approximately about 5 minutes. So you can go get a cup of coffee and still come back, but we're going to aim to start about 2 minutes after the hour. Thank you.
Yes.
Good morning and good afternoon, everybody. We're going to start in about 2 minutes, 2 minutes after the hour. So if you need to go get a cup of coffee, please feel free. We'll be here waiting, but we'll come back in about 2 minutes. Thank you. Good morning and good afternoon, everybody. For those of you who have joined, we're going to start in 1 minute. Again, we're going to start in 1 minute. Thank you very much. Okay, we have it at 2 minutes after the hour, so let's go ahead and get started. Again, good morning and good afternoon. Welcome to the Evenco Bloomberg Intelligence webinar entitled Harris versus Trump, Gauging Sector and Market Implications. My name is Nathan Dean. I'm a senior policy analyst with Bloomberg Intelligence here in the bustling Washington, D.C. office. But before I introduce our esteemed panel, we just do want to take a moment today to reflect on September 11th, say thank you, and our hearts and thoughts go out with those of you in the New York, Washington, and Pennsylvania communities. Also, before we introduce our esteemed panel, let me first state that we are taking questions via the Zoom Q&A function here on the Zoom function application. As we begin our discussion, please feel free to drop your questions there. We may not get to them all. We do have quite a bit of an agenda today, but we certainly will try to address those. And if you do have any questions that we don't address, please feel free to reach out to your Evenco representative or Bloomberg representative or through the LinkedIn social media contacts, and we will make sure that we get that information to you. So first off, joining me today, Daniel Kern, Chief Investment Officer at Nixon Peabody Trust Company, Jonas Thulin, Chief Investment Officer and Head of Asset Management at AP3, Daryl Montgomery, Professor, Author, Financial Journalist, and I would note one of the few people that accurately predicted President Trump would win in 2016, and Thomas Watts, Senior Investment Analyst at Aberdeen. So gentlemen, thank you very much for joining our panel today. So I'm going to start off with a high-level question. We've seen several organizations, news organizations, traders, portfolio managers refer to this idea of a Trump trade or a Harris trade. The idea is that if this candidate wins, there are sectors, equities that stand to benefit or potentially could be at risk from the outcome. Now, let's start with Daniel, and then we'll go on to Jonas, Thomas, and Daryl. Daniel, does the Trump trade exist? Does the Harris trade exist? Or maybe even if it doesn't, are there broad implications that you have for this election that you're thinking about as a portfolio manager?
Yeah, thank you, Nathan. There are definitely broad implications associated with the election. I like to start by cautioning everyone that I talk to that the election is an important driver, but it's not the only driver behind markets. But yeah, there is a Trump trade, there is a Harris trade. I think looking at this at a high level, when you think about relations with other countries, I think that if Trump wins, you'll see more pressure on Mexico. Mexico will be a less attractive place to invest, a less attractive place for multinational companies to do business and to extend supply chains. I think Europe will also struggle. There will be more in the way of trade sanctions against Europe, more pressure on European countries to fund the defense of NATO and to fund the Ukraine war if it continues. On the other side of the equation, I think a Harris trade will favor things like renewable energy. I think President Harris would be friendlier to Europe and be more supportive of a collective European defense. And so I think both candidates would put their thumbs on the scales in one direction or another. When I think about the election, though, it's not just about Trump versus Harris. I think the important factor will also be who wins control of Congress and whether you have a split Congress, whether you have the potential for gridlock. A lot of the things that are talked about really rely on whether there is one-party control of Congress.
And you're referring to the idea of reconciliation, where I think if the one party has the House, the Senate, and then the presidency, they can use this maneuver, this budgetary maneuver, to essentially bypass the filibuster. And this is how President Obama got Obamacare through, how President Trump got his Trump tax cuts through, how President Biden got the Inflation Reduction Act through. So certainly something to keep in mind on election night if you see the House and Senate, certainly, and so forth. So Jonas, I'll ask you the same question. Where are your thoughts heading into this election?
The last point, which I think is actually very important, in the sense that we do not follow so much Trump versus Harris. We focus a lot more on the possibility of a Democratic or Republican sweep, because that would enable a lot more forceful policy, obviously, for as you briefly mentioned, and then Daniel also raised that issue. I think that's crucial. And I think that we approach this, I think the common way of the market of looking at these things is to run all the data for as long as possible. So you know what's going to happen if you switch from a Democratic to a Republican president, what's going to happen if a Democratic leads to a Democratic, what are the S&P implications, what sectors will benefit from this, and you run all the election years. and everything. And in the midst of that, you always the risk is always that you lose the context of the election, what else is happening in terms of Fed policy rates, option expiring, etc., etc. And I think and the way I perceive things is that there are a lot of thoughts and ideas, but not too much flows as of yet generated in this, because we still need to take care of the Fed hurdle. We have the option expiry hurdle, and then in October we can start to focus on the election. So when we look at different baskets, we have introduced a few thoughts into the portfolio, but nothing major as of yet, because it's just too uncertain. And also, when I watched the debate yesterday, which Daniel also raised a very good point in terms of policy. I mean, we have more or less a elusive idea of the actual policies being presented. And I think Trump mentioned himself that he was working on a few concepts for economic plan. And that is a bit vague to risk money on, for at least for myself and this organization. So we're still looking for perhaps more clarity on what would actually happen. In terms of tariffs, I think that's actually very interesting, because if the tariffs are played out as they were the last time around, Europe ended up being, holding the losing stake, not necessarily China or the US in that sense. So I think there's a lot of sort of second derivative effects of these policies that we need to work through. So I think one idea that we have with the Harris win is that potentially you see more beneficial equity market in Europe. And that would be about time, because we've been on a losing streak now for what, 3 decades or something. So that's a bold statement, which we haven't put any money on, but I think it would be quite interesting if that was finally some momentum for Europe. Obviously, with the Draghi plan being, heavily protested by Germany, and here we go again without any growth objective or just capital flight. So that the capital movements from a Harris election will be quite interesting. But again, depending on which you get the Congress or not.
So Jonas, I'm going to have a quick follow-up to you. If I had the Federal Reserve in one hand and the election in the other, which one is more of, I don't want to call it a concern or an opportunity, which one do you think would have more of an impact, let's say 6 or 9 months from now?
I think it was good that you mentioned or threw on the 6 to 9 months, because if you're looking at 6 months, I would definitely go with the Fed. But at the end of the day, as we progress with the calendar, they will be more and more interesting. And I think the big year that we are sort of preparing, very long positions for and thoughts is actually on the next midterms. So 2026 is a bit more stressful for us than this election. But that also comes on the back of that we still do not know too many. We can speculate, we can buy baskets, we can monitor these things. We know vol will go up. We know that a Republican president usually means better equity performance. We also know if a Democrat leads to a Democrat, that's the actual better performance. But we view all that historical data analysis with a bit skepticism, because at least I haven't really found any clear answers on actual policy or deep enough answers to actually see any flows being sort of originated on this. And then obviously you can do the usual stuff. You can buy staples, you can buy real estate, but that's more of a Fed play than anything else.
Great. So Thomas, I'll go back to you in terms of your thoughts on the election and what you're seeing in the markets, and what is both a risk or an opportunity for you.
Well, I guess to look forward to what's going on in this current election, it's always best to look back. So if we look at the 2016 election, for example, and how markets moved when Trump first got in, you saw big rallies in US domestic stocks, companies in the technology, financial sector did particularly well. And we also saw treasury yields drop as well. Of course, those are very different times. But if you take that and you kind of transplant it into what we can see now, I don't think it should be too different from what we're seeing. In fact, if we look at how the polls have sort of reacted to Trump and Harris over the last month or two, actually we get a fairly good idea of what the Trump trade could be. So we've seen, for example, the US yield curve steepening, then flattening. I know there's other factors at play, but certainly as Harris has come more into the election, we've seen that yield curve starting to flatten. Again, I think that could be a key characteristic of what we'd see going forward under a Trump administration. And then under a Harris administration, I think it's a lot easier to try and work out what might be going on, because really it's a continuation of what Biden was doing. There are some nuances, of course. I'd say that Harris is more progressive than Biden. Biden was very much centrist, and Harris is a bit more progressive than that. So you'd see kind of a push towards more renewables, more kind of workers' rights, that kind of stuff, which, maybe Biden wouldn't, would focus on, but maybe not focus on as much as Harris. So from the two, it's easier for markets, I think, if there's continuation with the Democrats, but under Republicans, actually, we only need to look at 2016 from 2020 to see what a Trump trade might kind of work out as.
No, that sounds great. And Daryl, I have a question. It's a little bit slightly different. You just heard the rest of the panel talk about how policies, and one of my key themes is that this isn't so much a policy election. We're not getting nitty gritty, much to my disappointment, because I'm a policy person. But we're not getting a lot of policy. So what are the themes that portfolio managers can think about in terms of this election? Like, if you think of what President Trump could do versus Vice President Kamala Harris, are there key themes that are emerging? And then following up, I would love to get your thoughts on something Jonas mentioned, the importance of Congress and even the next midterms. How should people be thinking about how Congress reacts to this?
Well, Congress is key in this election. As mentioned, a president with the opposite party cannot do very much. So, and I think we're going to have the same party. So, and I have a broader perspective on this. This is really a conflict between the classic and extreme Democratic policies and basically classic Republican policies in the United States. And Harris is going to pursue a high tax, high spending, high regulation agenda, which is generally very negative for business. And, if you look at her previous policies, and they change rather frequently, it's very much Jimmy Carter 2.0. So you should look back to 1976 and 1980 for hints of what could happen. Now, Trump is all the way on the other side, very low tax, low regulation, but high tariffs. And that's a sort of a key difference. So between past Republican policies. So that will affect the world as a whole. And I think we're heading for higher tariffs, period, globally. And, I wear two hats. I also created the global bifurcation theory in geopolitics, saying the world is splitting into two parts. And higher tariffs is projected as part of that. So everything is sort of fitting in. So, and we'll talk more about tariffs later on. So does that answer your question?
It does. And,
okay.
One thing that I would just state for those of you who are listening, generally, when it comes to the midterms, like Jonas mentioned, the next midterm, generally we see a swing back to the opposite party. So whoever wins the presidency, generally speaking, there is a swing at the midterm going back away towards the more centrist. I would argue that American politics is like a car running around with bumper, guardrails on both sides. It goes left, right, but it rarely ever goes straight down the middle. And so, if you would see in the midterm elections, there's usually a pullback from the party that wins the presidency. And Daryl, just one quick follow up to you. You mentioned classic GOP policies. One of the questions we often get is this idea of economic populism that is really a core of Senator J.D. Vance, the vice president candidate, who has been very tough on big tech. In fact, he came to Bloomberg a couple months ago and called Lena Khan, the Federal Trade Commission, the chairwoman of the FTC, one of Biden's best picks, and even insinuated that President Trump should keep her on. If President Trump wins the White House, is it going to be a classic GOP, U.S. chamber, aka good for big business type of presidency, or could economic populism get in there and be a threat to the tech sector?
We're going to see economic populism. There is a shift going on, and it's classic in the sense of low taxes, low regulation, which the Republicans have always been in favor of, and the Democrats have always been on the other side. Trump has actually moved the party, though, toward economic populism. And we are going to see more of that. And you're actually seeing a shift of what each party represents. And we'll talk more about that later.
Great. So let's talk a little bit more about President Trump's policies. And please, feel free to jump in if you have any questions. And for those of you listening, please use the Q&A chat. We will certainly get to those questions. But let's talk a little bit about President Trump's policies, because he's called for the corporate tax rate to drop from 21% to 15%. He's called for 60% tariffs on all goods coming from China. We saw him say 100% tariffs on countries that move away from the dollar. Again, a desire to cut regulatory red tape, very similar to what we saw in the Trump 1.0 presidency. So, Thomas, I'll start with you. Are there opportunities or risks? And I want to make sure that you use both. What are the opportunities and risks that come up? Oh, sorry, Daryl.
No, that's okay. The sun is moving.
Oh, no. What are the opportunities and risks, Thomas, that you see in a Trump-specific administration?
Thank you. Yeah, well, no worries about the sun this side, Daryl. I've got to say, being in London, so you're lucky where you are. Count your blessings. But yeah, there are obviously risks and opportunities to tariffs. I think actually the Peterson Institute the other day came out with the data that if Trump was to introduce 10% tax on every country and 60% on China, actually that would raise about 225 billion per year for federal revenue. However, of course, that has a big impact on economic growth. So you've got to take the rough with the smooth when it comes with that as well. Obviously, there are several benefits, and actually one that's sort of overlooked is in Europe, because you'll have this kind of dumping, if you like, of EVs into Europe. Obviously, China, Korea, those kind of countries won't be able to sell their vehicles as freely in the US. And actually, what that could do is you could actually see European governments actually raising their own tariffs on Asia and other countries' electric vehicles, just because the US has, and actually it acts as a good excuse to be able to try and push up tariffs and then try and sell some more of your own vehicles within your own country, which is something not a lot of people have been thinking about so far.
Well, I'll just say that, I used to live in Europe, and one of my dreams was to buy a Skoda, and I've never been able to buy a Skoda. So every time you talk European EVs, I certainly get excited because for some reason I really want that Skoda. But so Daniel, let's turn to you just to talk but same question, like opportunities, risks, tariffs. You mentioned Mexico. I'd love to hear your thoughts a little bit deeper on Mexico. And for those of us here in North America, Canada and Mexico are extremely important to the trade argument. So could you just give us a little bit more color on where you're thinking in terms of a Trump administration?
Well, I think that the pandemic, if we go back painfully to the pandemic illustrated the challenges associated with having far-flung supply chains, and that many companies would like to do more in the way of nearshoring and friendshoring, and Canada and Mexico fit in very nicely in that framework. But I think that under a Harris administration, there would be fewer feuds with our neighbors to the north and south, and more a continuing expansion of supply chains into both of those countries. With that said, this isn't a one-note election, and although I think Harris will be friendlier to Mexico than Trump would be, certainly we have issues with the rule of law as AMLO departs Mexico and tries to change a lot of the longstanding rules there with regard to election of judges. So I think one of the important things in looking at investment opportunities is you've got to factor a multitude of considerations and not just look at what the election result would be. I'd also like to step back and say that we hear a lot in the campaign and a lot in discussions like this about what each candidate wants to do. And we talk about Trump and 60% taxes on this and across the board taxes on that, tariffs on that. Harris and the desire to raise taxes, have a potentially a wealth tax, all kinds of things that the candidates want to do. When I think about investment decision making, I think about preferences versus constraints, and I think constraints tend to rule the day. And whether that is who has control of Congress, and even if it is a Republican or a Democratic sweep, it's likely that the margin will be narrow. If you look at the influence of senators like Joe Manchin during prior debates about policy, having that narrow margin means that it's unlikely that the more sweeping ideas will come to pass. Trump was frustrated for 4 years because he wanted to replace the Affordable Care Act and didn't really have a good mechanism for doing so. The other thing that I think is important to think about, especially with regard to China, is that there's a second order effect or reflexivity to whatever policy is employed towards China. Both candidates are going to be tough on China, but China's got an ample ability to retaliate, and there may be some unintended consequences. On one side of the ledger, yes, a broad-based tariff would bring in a lot of revenue, but the question is, what's the other side? What's the other implication if China restricts our access to rare earth materials, whether their consumers retaliate against American multinationals? There's more than one side of the equation, and I think that it's easy to underestimate what the retaliation might be.
And it's very topical that we're having this discussion today because it's considered China Week in the House of Representatives right now. There are, I think, something like 24 bills that are being voted upon this week on China. And my own personal, through my own research, we often caution our clients to just remember it's very popular to be tough on China if you're an American politician, and especially if you're in the House and the Senate. But when it comes to the president is the one that actually looks Xi Jinping in the face and actually has to have that discussion. And so we often see presidents be tough on China, but there are always opt-out cards, or there's always flexibility, or there's always ways to dial back rhetoric. And so something to just keep in mind from the process portion of Washington is that, Congress, it's very easy for a Congress politician to be tough on China. So thank you for that. Jonas, let's go to you and talk a little bit about tariffs. And I'm going to integrate one of the questions that we received from the audience was, in a potential Trump administration, is there ideas for this idea of trade wars? What are the implications that these may shift on global supply chains, market volatility? And because you mentioned 6 to 9 years, is there a long-term play here? Is there a long-term concern that if we have 4 years of President Trump, or an opportunity that the world may look much different 4 years from now in the global trade space?
Thanks, it's also
Sorry, Jonas, I'm having some audio difficulties. Let's try that again, and I'll mute and see if that.
I think also carefully steps side which have when an economist have or a politician or a market. I put on my economist hat, it's quite popular to use there are these tariffs. We can speculate how big they will be, the way the economic impact, blah blah blah. But that's not actually happens. I don't think.
Sorry, Jonas. I think your audio is still. Maybe could you move a little bit closer to the mic? I think there were a couple points where it was coming in quite clear.
Microphone.
Okay, try that. I think I heard microphone really well, so let's try that.
Briefly catch up. I mean, I think you have to decide if you're going to view this as an economist, politician, or an investor. I think there are big differences. I think we all learn from university, we can calculate on tariffs, we can come up with some GDP estimates. But if you look at the last so-called trade war, there really wasn't a trade war, was there? I think there was a general idea that, yes, we put on tariffs from US on China, you're going to import inflation, blah, blah, blah. That didn't happen. What actually happened is the import prices from China to US were always negative. What actually happened is that Chinese, which has very strong monetary and capital muscles, slashed the prices of the goods, so the prices were still going down in the US. Obviously, what's going to happen when you slash your costs is you're going to have different winners and losers out there in the economy, and the capital flows found this very, very quickly. And that's why I'm concerned. I'm not so much concerned, which might sound a bit weird, if you're going to have, US inputs on tariffs on China. I'm not so concerned about the Chinese economy. I'm not so concerned about the US economy. I am concerned about those who's going to end up on the losing stick. Last time around, it was Europe. Clearly, the Chinese bought corporate company shares or market shares, I should say, in Europe. We were in equal size with the US in 2008, about 15 trillion economies. Since then, we've been stagnating in Europe. Since 1994-ish and the introduction of euro, we have lost 75% of our economic weight in the world. So I think there's a tendency here of looking at tariffs, who can respond and how do they respond it, and how does the market interpret those responses. It's a great way to make money in 2016 and 18 when everybody was on about trade war, because there were clear winners and clear losers. And that's sort of what when I look at this tariff question, I could almost disregard the economic jargon around this and just look at, but bring it on. There will be clear winners again. There will be clear losers again. How will the European Parliament respond to this? Will they slap on retaliated tariffs? What will they do with the Chinese? Et cetera. Those are the really questions. And that really got fumbled the last time around in Europe, not so much in elsewhere. So I think I'm always afraid to say that. I think that's how the market will look at this again. We're trying to seek out, yes, bring on the tariffs, and let us find out who will actually end up on the losing stick on this. And then you can argue that in the long term, the real estate fiasco in China, how much was that responding to? They had to, fiscally introduce stimulus in order to reach the Trump's tariffs. So there's a long-term game here in terms of how long can you afford to stimulate your economy in that way. So I think there's as all these macro events happen, there will be winners and losers, and we will do the number crunching to try to figure out where do we actually see it? What is the actual impact on it? And that could differ heavily, I would say, compared to the normal economic theory of the effects. Right or wrong, the market is going to do its own analysis on this.
No, that's a great answer. Thank you. And I would just caution for those of you listening, just one of our own theses is that you have to remember how Washington operates. And there's really, I would argue, three ways things can get done. It's legislation, regulation, and executive order. And legislation, you don't need to be me to note that legislation is not easy to come by. Regulation, yes, you can bypass Congress, but there's time, it's length, it takes years, and the courts are becoming a little bit more skeptical of regulations. But tariffs falls in this executive order branch. And I would argue that 85% of executive orders are symbolic ways of the president picking up the phone and directing his staff or her staff to do something via the legislative route or the regulatory route, with the exception of tariffs. Congress has deferred a lot of authority to tariffs to the president, and there's a lot of power. The power of the presidency is a lot more powerful when it comes to tariffs. So if President Trump wins, or even if Vice President Harris wins, and you start to see in the news cycle tariffs, this is something that could be more of an immediate risk than something that, like, compared to legislation or regulation. So Daryl, I'm going to take the conversation over to you, and I want to talk about polling, because polling is something that I struggle with even as a policy analyst. I mean, I gave a speech 3 weeks before President Trump defeated Hillary Clinton, and I said the polls suggest that Hillary Clinton's going to win by a landslide, and that didn't happen. So, and obviously others, please jump in if you have opinions here. But Daryl, as a polling expert, how should individuals look at polls where we have an extremely close race? I mean, it's a toss-up by everything I'm looking at. Do we believe the polls? Should we ignore them? And what should we look for on election night so that for those of us who are going to bed or waking up early in the morning, maybe have an indication of how the race is going?
Okay, well, first of all, a toss-up is bad news for the Democrats. U.S. polls tend to have a bias toward giving a few extra points to the Democratic candidate. And this has been pervasive for decades. It's nothing new. So, and what you want to do with polls, they tend to become very honest right before the election, like that weekend or the Friday before. And that's where you get your better polls. Not necessarily accurate, but they're moving in the correct direction. And I remember 2016 quite vividly. The key is there were some hints actually right before the election, the weekend. You'd like to see where the candidates are campaigning. Now, what states they're going to, because their internal polls are telling them that those states are close. So if those states are Pennsylvania, that means Pennsylvania is very close. Hillary Clinton campaigned in Michigan and Pennsylvania right before the election in 2016. And she wound up losing both very narrowly. They obviously had polls saying hey, there's a problem here, we better go here. So see where Trump goes, see where Harris goes. Now, if Harris goes to a relatively Democratic state, that's very bad news. She's trying to shore up the Democratic base. If Trump goes to a very Republican state, that's also bad news for him, unless there is a hotly contested Senate race there. Trump actually campaigned in Montana a month or 6 weeks ago. There's no chance he's going to lose Montana, but there's a close Senate race there. So you have to keep that in mind. So see where the candidates campaign. And on election night, you can see the relative performance. I knew Trump was in very good shape after just 2 states in 2016, and that was Kentucky and Indiana. They are both very Republican states, but Trump was running way ahead of Romney in 2012. So that indicated the Republican base was very solid. And indeed, that showed up in state after state after state, and meant he could win. So you can see, like, a Republican state's much better. Now, he hit maximum vote. It states like that, I don't think he can do any better. You would like to look at Democratic states like New York or New Jersey, which are, they're not a blue wall, they were a blue fortress. New York always votes, the last 2 elections, 23% margin for the Democrat. So if that's running around 23%, everything's normal. If it's running around 15%, which says, well, oh, Harris is winning, she's not winning by enough. And that's the key. You can look at either side. Now, if the final returns, the Pennsylvania, if Trump wins, he's won the election. Harris wins, maybe she's won the election. But it's and that's an East Coast state. So the East Coast states tend to come in first. You could also look at New Hampshire, which Trump lost by less than 2,000 votes in 2016. If he winds up winning that, that's a key. He's doing very well. And these are early states. I mean, if you want to stay up to 2 or 3 in the morning, you can look in Nevada and New Mexico. And, you know, I do, but not everyone else does. So you can tell pretty early on by how the returns are coming in. But keep in mind, in very close races, you can be up to 2 or 3 in the morning before you find that final result, which is what 2016 was like.
Do you think we're going to have we're going to know the next day who the president's going to be?
Yes. Oh, I think so. Yes.
Great. Jonas, you had your hand up. We would love your thoughts.
2016 was a great also money-making opportunity. We also accurately predicted Trump winning, but there's a neat way by you can calculate the probability of a switch in U.S. presidency from the FX and from the equity market. The hit ratio since the 1928 is about 95% in the equity market. It's 85% in the foreign exchange market. So the market has a way of not looking at polls, but rather looking at what actually happens within the market. Obviously, the market is looking at polls, but you can sort of derive alternative or complementary or even supplementary indicators by looking at how the market is actually trading. And the signal and as I said, it's pretty tough to predict, each presidential Republican or Democratic switch by 95% hit ratio. But the equity market has been very good on this. So what we're going to do is we're going to study those type of math very, very hard, as close as we get to the election, and try to, in complement to what was just mentioned by Daryl, also look at how is the market tilting. And it will be super interesting if the market and polls have a different view on these things. Not too often that actually happens. But from our point of view, we're probably going to go with the market at the end of the day. So I think those are really complementary sort of suggestions on ways of looking at this.
Great. Thomas, I see your hand up.
Oh, big English and having had our fair share of polls, especially around Brexit, which, point to one thing and then don't happen. I remember speaking to clients the evening of that Brexit vote. We're looking at currency and sterling was, up above 150 on the dollar. I was saying to clients, this is one of the last ways we can look at the odds of this referendum. And obviously currency markets are telling us one thing, and then of course the voters told us another thing. But an interesting metric we're sort of looking at and putting increasing amounts of stock in, amongst other surveys or whatever is the misery index in the US. I'm sure, Daryl, you probably come across this before, which it takes basically the pulse or the mood of your average US consumer in October the year beforehand. So it asks consumers questions on their general economic outlook, how safe they feel in their job, their spending plans, their views on immigration. And then basically that level is taken. And then the index kind of goes along until October of the election. And usually if the misery index is below what it was, then actually the incumbent should prevail. I think this has predicted 15 of the last 16 elections. And if the misery index ticks above the level that it was back last October, then I guess people are sort of looking for a change. I mean, it was one that was much touted back here in 2016 because it was right. People obviously who are tired of the current situation tend to vote for change. And that's one that I think we're looking at increasingly, amongst other sort of metrics and votes and polls. But it's an interesting way of looking at who will win.
Great. And Daniel.
So it's always dangerous to say this time is different. And I'm a big fan of the misery index as an indicator of political sentiment. I think what's more important this time around, I think if you look at unemployment, where unemployment is, where unemployment was over the summer, where inflation is trending, that would be favorable to Vice President Harris. I think this time, because of the skyrocketing inflation during and in the aftermath of COVID, I think the key thing to keep in mind is that the mainstream Americans' living standards have declined. And although inflation is coming down, price levels for low and middle income consumers are higher, have outpaced income gains. Not so much the case with higher income households who benefited from rising asset prices and who have also benefited from rising wages. But I think you've seen a real squeeze for lower and lower middle income consumers. And that's one of the things that I think is fueling economic and political discontent. I think that's a bigger factor this election than it has been in past elections. And I, think about the Reagan-Carter election, where the misery index was really the big driver behind Carter losing in a landslide.
Do you think just to follow up to you, Daniel, on that point, do you think that there are policies that we've seen from either President Trump or Vice President Harris that can deal with inflation? And then I guess, I was in London earlier this year and I went to my local for a coronation chicken sandwich and I realized the price of that coronation chicken sandwich had gone up quite a bit. Is there a role governments can play in this, or is this something that's really just macro level factors, the Fed, meatpacking industry, for example? I'd love to hear your thoughts.
I don't want to be flip about this, but at the risk of being flip, I will be flip. I think the policies that I've heard from both candidates really won't do anything to help the cost of living crisis for many American households. Price controls historically haven't worked. It's been painful to hear about price controls being discussed. And I think a lot of this is just general macro pressures. We've learned the perils of just-in-time inventory and of complex supply chains. I think we've got climate is an issue and creates periodic disruption of food supply. There are just a lot of things going on in the world that are major trends that I think will be very difficult for any candidate to overcome. I think that the policies that can help are policies that promote employment and economic growth, and so putting us in a position to outgrow some of the inflationary pressures that I think will be persistent over time.
Great, thank you, Daryl. I see your hands up.
Yes, I wanted to add something before. The key to this election, and it goes back to 2016, is this is a realignment election. And I wrote my book that Trump would win in 2015, a year before the election. And at that point, nobody thought he was going to win. No one thought he would even get to the primaries. No one thought he was a serious candidate. But the tea leaves said that the American public wanted some big shift to take place. And that still exists. That hasn't disappeared. It was derailed in 2020 because of the COVID epidemic, which made things sort of shift to the side. But that's sort of a temporary phenomena. And a realignment election is like Carter Reagan that was just mentioned, or FDR in Hoover in 28-32, where the components of the parties actually shift to different components. So that has to be taken into account. And people did not take that into account at all in 2016, which is why they missed the picture.
Great, thank you. So I'm going to do the dangerous thing of trying to combine two questions into one. And what we're going to talk about next, I think, is very important to not just American investors, but also European investors and global investors, and that is tax policy and the Inflation Reduction Act. And the reason why I'm combining them is because 2025, we have all the individual tax cuts from the Trump era tax cuts expire at the end of 2025. So no matter who wins, there's going to be a robust tax debate next year. You know, Kamala Harris has said that she wants to go to 28% on the corporate tax rate. President Trump has said 15% on the corporate tax rate. Like Daniel mentioned earlier, you know, control of Congress will be very key to getting to those numbers, if not. But the question I have is, what do you think the most important things to keep in mind is for the tax debate? And because the Inflation Reduction Act could be a part of that, and if President Trump wins, there could be cuts to the IRA to pay for these tax cuts. You know, are there concerns or opportunities, A, with the tax debate, or B, with the Inflation Reduction Act? And Jonas, let's start with you first.
Forward to my phone. No, for sure. I mean, this is something where as soon as we get rolling and we can start to see the policies, we have work whereas we usually tend to work with these things, and it's just to map out, just take all the equities listed in the US, throw in different tax brackets, study what effect will be what, state basket, do spread, long shorts if you're uncertain, long short versus the index if you're even more uncertain, or outright just longs or shorts if you're more certain. So there's in the usual sort of playbook that comes into play on these things. The tricky part will be perhaps to understand fully what taxes will hit what corporates and when. But I think that would actually work out quite methodology as the policies are being pushed through the regulatory channels. We should have ample time to pick that up. And I think there will be you're probably going to see this from, you know, the usual suspects out there in terms of U.S. investment banks that would throw out baskets on this, you know, left and right. And so that's really how we're gonna play this. We do not take an agnostic view if this is going to be good or bad for the U.S. economy, given the dire straits that we have elsewhere in the world. So that will be another thing that we start to look at. Would it originate capital flows from the U.S. to Europe, for example, that I spoke about before? And really that comes on the back of what will Europe do. So I think that is all a relative play at the end of the day. But we're sort of going to look at that and do our usual math, just to, you know, take all the listed companies and do the number crunching and throw up the baskets, and then we see what sticks on the wall, basically.
Great. Thomas, can we go to you next?
Yeah, of course. So the Inflation Reduction Act is particularly interesting, I think, from a European point of view. Now, Europe is a much bigger advocate of ESG investing, environmental social governance, than the US. The Inflation Reduction Act is one of the largest environmental focused policies in US history. It focuses on clean electricity, EV, sustainable fuels, building efficiency. If you do get a reduction of that, and imagine you probably see a lot of flows from ESG funds, from ESG holdings, out of the US into kind of European equivalents or maybe even Asian equivalents. It's just worth stressing how much more kind of ESG orientated Europe is. And I think you'll probably see a flow away if you see a reduction. But I think the stats were something like 11 billion, even this quarter or first quarter of this year, have flowed in to ESG portfolios, whereas you've seen 8 billion out. Over here, you're encouraged. I think it is actually, you have to now, when you're seeing a client, for example, you have to talk to them about their ESG aspirations if they want an ESG portfolio. So we are only getting more popular. I'm sure Jonas will back me up as well, especially in Scandinavia, where ESG is a big thing as well. So yeah, if you see a reduction in this Inflation Reduction Act, then yeah, I would imagine that some money would definitely flow away from the US.
And Daniel, your position as a global investor, I mean, think in terms of thinking globally, what are your thoughts in this space?
So what's interesting to me is, in particular, if Trump is elected, is the Inflation Reduction Act, at least on the face of it, would be in jeopardy under a second Trump administration. But what I think is interesting and will create some trade-offs is that about 80% of the IRA funding for clean energy deployment is going to red states. And more than 70% of EV funding is also going to red states. So there's, I think, an interesting political trade-off between tax cuts and spending if Trump is elected. But I think that Thomas's point is a really good one. If the U.S. spending on renewables is cut back, if government spending and permitting and basically encouraging of the facilitation of climate transition, if that is cut back in the States, we'll see money flows going overseas to Europe and to China. Because that's where the action will be. So for everything that takes away an opportunity in one region of the world, in all likelihood, it creates opportunity in another region in the world. And maybe as a former international equity portfolio manager, I'm really looking forward to the day when European and UK stocks leave the wilderness and have their moment in the sun again. I didn't realize in the 90s when international stocks were the place to be, that would fade, and I'd be spending a couple of decades just lamenting the lost decades in European and UK stocks.
Well, that sounds great. So we have about 11 minutes left. So I wanted to get to some questions, make sure that the folks listening get some of their questions. And so,
Okay.
Daryl, the first question I have is for you. Did the debate last night change your opinion on who won? Did it change anything? Or, did the endorsement of Taylor Swift be more of an impact than the debate itself?
I don't think the debate changed anything. And I think there were very few undecided voters, first of all. I mean, Trump has been around a long time, and you either like him or hate him. People have very strong opinions, and they've decided whether they're going to vote or not. And basically, whatever's left over is the Democratic vote. And I'd like to point out there are three problems in the Democratic base. The three major bases are Blacks, Hispanics, and people under 30. And Biden had problems with all of them with support. And Harris' support looks a bit squishy also in those three groups. So, and the key to winning every race in the United States is you must appeal to your base and get maximum base vote. And the media constantly go, swing voters, independents, no, that's not really where the action is. It's who gets, the Democrats and Republicans are approximately balanced in the United States. Who gets more of their people out is the key to winning the race.
Great. So I'm going to open up this one to Thomas, Daniel, and Jonas, if you have any opinions on this. We've had several questions come in about the outlook of fixed income. I know we're talking about equities mostly, but does anybody have thoughts on fixed income and what the outlook would be like under a Harris or a Trump presidency? Are there specific sectors that would present higher growth potential?
So I can jump in here. So I think fixed income is really interesting regardless of who wins. There's a major shift in the U.S. and in most of the world away from austerity and towards fiscal dominance. So we've had a long stretch of time in which policies really been driven by central banks, and the era of central bank supremacy, I think, is over. Neither party is really concerned about the deficit in the U.S. And although in Europe, the Germans still are a brake against expansionary spending, even their resolve is fading somewhat. I think that means that In the near term, we expect the Fed to cut rates next week. The Fed's got a lot of room to cut rates. The ECB should be continuing to cut rates. We've got, I think, on the short end of the yield curve, rates are going to go down. But I think with the budget deficit and the accumulated debt growing, I think the outlook for longer term interest rates is that we'll have higher highs and higher lows. So I think it's important to be cautious in how far you extend duration. The other opportunity in the U.S. is I think that if there's a Harris administration, the likelihood is there will be pressure on taxes, and the top tax rate for individuals is likely to go up. That makes municipals even more attractive. So I think I'm a municipal bond bull, and bullish in the near term on short rates, not so bullish on long-term rates.
Great. Thomas, Jonas, any thoughts on fixed income? Otherwise, I have another question on China that I'd love to ask you.
I couldn't echo Daniel's sentiments more. I think there's more volatility on the long end at the moment. Short end is probably where to be on US bonds at the moment. I guess the only factor is you've got an increasingly accommodative Federal Reserve. So that's always sort of acting as a backstop going forward. But yeah, at the moment, yeah, short end for us.
Great. So Jonas, I'd love to ask you a question on China. One of the things that I often hear is, and just at a simplistic level, should the U.S.-China relationship keep us up at night in terms of, are we facing a dramatically, or what I would call it, are we facing a confrontation either militarily or economically or anything of the above that would impact your portfolio, or something that you should be preparing for now? And then, as part of that answer, we can certainly go into more geopolitical in the short time we have left about Ukraine and Taiwan and so forth like that. So very high, open-ended, broad question to you, but would love to hear your thoughts.
We've taken a decision, and it's a combination of a 2-year project where we decided not to invest in China anymore in Chinese companies. So to ask that question, our answer becomes a bit black and white in that sense, that we do not longer invest in China domestic and equities, basically. So for us, yes, we would try to triangulate what's happened now from a financial point of view, geopolitical point of view, human rights point of view, freedom of under law, democracy, rights, etc., etc. And we make a country screening all across the world, actually. And for better or worse, the current threshold that we have, there are a number of countries that do not qualify for us as being investable and sort of represent the core values that we as a government entity of Sweden represent. And right now, China and a number of other countries are non-investable.
Great.
For us, it's sort of almost naive answer in that sense. It becomes sort of an on or off question for us, really. And right now we're off.
And Daniel, Thomas, Daryl, any thoughts on the U.S.-China relationship?
I lose sleep at night over the China-U.S. relationship, over the risk to Taiwan if China decides to try to reunify Taiwan and the mainland by force. I think China is still investable at a company level, but selectivity is really, really important there. The Middle East is a concern, and probably a more pressing near-term concern. And then from a humanitarian perspective, what's continuing to go on in Ukraine is troubling. I would say that these situations influence our view, but the market, and we're no different than the market has trouble discounting low probability but high impact events. And so when I think about China, Taiwan, when I think about the conflict in Gaza spreading into a hot war between Israel and Iran, it's hard to discount that in stock prices, and the market doesn't particularly do a good job of it. So it's hard to say we've changed an investment decision because of those geopolitical considerations.
And Daryl, I'd love to hear your thoughts on the U.S.-China relationship, especially, you know, as from the Washingtonian White House point of view. Where are we going to see that go ahead?
This is just going to get worse. There's going to be a trade war with tariffs, if not a hot war. And this is just an extension of Russia, Ukraine, and the Middle East. There are these three hot spots, and there's this struggle going on between what I call the collective West and the collective East. And the collective East is rising. And so whenever that happens, historically, for thousands of years, you get conflicts between the two regions. And if you look at PPP GDP figures, China is number one, not the US now. And India is number three, and Russia is number four. So, and those were just upgraded. So this is an ongoing issue. It's not going to be just this election. This is the next several years we're going to be facing this. And the other thing I like to say is it's growth. The growth center is moving to India. I mean, China is the issue right now. In the future, it will resolve, and growth is moving elsewhere in the long term.
Great. So we have about time for one more question, and this we're going to go round robin style. So just fairly a quick answer and so forth. So Thomas, I'm going to start with you. What is the most important thing that will be impacted by the outcome of the U.S. elections? Could be a sector, a trade, an asset class, a policy. What's the one thing that you're looking for?
Well, I'll tell you what, I'll go slightly non-consensus. I'm sure the other guys will give broader themes, but I'll say one stock in particular will do particularly well if Trump gets in, and do particularly poorly if he doesn't. And that'll be the parent company of social media, Truth Social, Trump Media. We did see that after this assassination attempt, that stock rose 30% the first day of trading. I can only imagine how it would perform if he was to get into power. And I can only imagine how it would perform if he didn't get into power. So yeah, I'll give something that's slightly left of field for that.
We always love out of consensus. I think everybody on this call loves out of consensus. So thank you for that. So Daniel, I'll go to you.
So I think most of the action, regardless of who wins, is going to be on the trade front. And so I think the result of the election, the incoming president will have the greatest degrees of freedom on the trade and tariff front. And so I think you'll see either major headwinds or major tailwinds, depending on who the winner is.
Great. Thank you. Jonas?
From my point of view, I guess the key word for us is rotation. We will actually see rotation into small caps. I mean, I guess you all know that if the market is betting on if Trump wins, they're going to be a rally in small caps. We will see that type of rotation out of growth into value. We see rotation out of the US to Europe for all the reasons we mentioned in terms of ESG, to tariffs, etc. So for us, the key word is, will there actually be any type of rotation as a concept or a broad market theme? And if so, when should we put it in the books? What parts should we try to front run? What should we be sort of moving back in the bus a bit? What should we do through derivatives, etc., etc.? So for us, rotation is the key word.
Great. And Daryl, sorry, go ahead, Daniel.
Can I take 30 seconds to just amplify Jonas's point? Small caps were great trades after Trump was elected in 2016. U.S. small cap market went from up, roughly 10% to up 30 by year end. That ended up being a trade rather than a durable bull market, because the earnings and fundamentals didn't follow the sentiment. So I think it's very important, if Trump is elected, to think about whether whether you're a renter or a buyer. And I think you need to see the earnings and cash flow follow through in small caps post-election.
Great. And Daryl, the last word is to you.
Okay, we're heading into a high inflation environment. I agree. I think Daniel said this before. So gold is the answer. There's very high inflation with Harris, and there's high inflation with Trump. It's just worse with Harris, that's all. So gold has broken out from a many 13-year base, and hitting all-time highs.
Great. Well, with that, I think we're at the hour. So Thomas, Daniel, Jonas, Daryl, thank you very much for appearing today on our panel. For those of you that are listening, again, thank you for attending this Evenco International Bloomberg Intelligence webinar. If you are going to be in Switzerland in 2 weeks, Evenco is doing their roadshow in Geneva and Zurich. I am highly envious. I wish I was with you. But if you do have any questions, please feel free to reach out to myself or the Evenco representative. Follow us on LinkedIn, both at Evenco and Bloomberg Intelligence. We will make sure that we will get the answers to the questions that we didn't get to today. I wish you the best of days, great week, a good morning, and a good afternoon, and thank you very much again. Take care.